It's a delight to have you on the podcast, Cathie. Let's dive right in. How does it feel to partner with Avanza to bring disruptive innovation strategy to the Swedish market?
Well, I'm delighted to be here, Nicholas. Thank you for inviting us. We are thrilled to be partnering with Avanza on our disruptive innovation strategy. I've always been very impressed with the Swedish focus on R&D and the countries really laying out the infrastructure to make innovation happen. I think there's a DNA in Sweden that we can certainly relate to. We're all about disruptive innovation, and it's such a pleasure to be launching with a fund company that is actually creating the financial revolution, fintech revolution in Sweden and
Oh,
perhaps beyond.
thank you very much. Thank you very much, Cathie. So let's start from the beginning. Who is Cathie?
uh, I don't know how far back to go, but I have been I've been involved in the asset management industry for more than 40 years, and have been managing money for the last 30 years. All the time focused on truly disruptive innovation. Now, how did that happen? It happened because when I got to a company named Jennison Associates in New York City after working at Capital Group for a number of years, um, I was given the opportunity to move into equity research. However, I needed to find my own universe, and the chief investment officer told me, "You're going to have to find your own group of stocks to follow. None of the analysts are is going to give up any of their stocks." And so I was like a little dog under the table, scrapping around, looking for new ideas. And it just so happened that the new ideas were what we called back then fall through the crack stocks. They were like database publishing in the early days of Reuters and Telerate. Database publishing is what we called it. The technology analysts didn't want it, so database, yes, but publishing, no. The publishing analyst didn't want it, publishing, yes, but database, no. And I said, I'll take that. I'll take that. I found it a really interesting model. And of course, that was the precursor to the internet. There was a lot of misunderstanding. And when I see a lot of misunderstanding of new ideas, I actually study them more carefully. And so what we used to call fall through the crack stocks, we're now calling the convergence between and among technology stocks. And you'll find a lot of those in our portfolios. So, who is Cathie Wood? That's how I started. And then, in terms of why I started ARK Invest, well, I started it because I saw, particularly after the tech and telecom bust in the early 2000s, and even more so after the financial meltdown in '08 and 9, I saw our industry moving towards passive investing or very benchmark sensitive investing. And so I was looking at what they were doing, and we were moving in the opposite direction, moving away from benchmarks. And the reason for that is benchmarks are very backwards looking, and there is a place for tried and true, no doubt about it. But when it comes to truly disruptive innovation, it's all about the future. And so I knew that there was an unmet need in the marketplace that we could fill. And that is a pure play focus on disruptive innovation. So I think we've carved what many people consider a niche out there, but we don't consider it a niche. We actually consider it, because it is the way the world is going to work, it is where all the benchmarks are going to migrate over time. And then we'll be on to the next thing. But there's a lot of alpha generation between the time we get into stocks and the time benchmarks understand, oh, this is the way the world is working.
How long does it take for the world to wake up to see what I guess you see what will be the big things in the future?
Yeah, well, I think the last 2 years have been instructive on that. In the advertising world, for example, a lot of us are waiting for the advertising in linear TV, which globally is roughly $170 billion, for that to migrate to digital. And so a lot of people who were holding the FANGs, particularly Facebook, Netflix, Google, were looking at a very long period ahead. It's going to take a long time for that to happen. However, what happened in the last 2 years? TikTok. TikTok came along, of course, and
Yep.
is disrupting the traditional world order so that these former disruptors are being disrupted. And, we don't own them. And we haven't owned them for 18 months to 2 years because we were looking at this disruption. But these stocks have become very big parts of indexes. So everyone felt very safe in these stocks. Well, guess what? That ended badly. Now, I will say the last 2 years have been very difficult years for innovation across the board. So even our disruptors, they've been treated just like the FANGs. But we think over the next few years, the market's going to sort out who is being disrupted from the disruptors. And I think that our strategies being populated by the disruptors will be favored over time.
Mm. And I know Netflix built the market for streaming going away from linear TV. And I remember when Disney and Disney Plus was launched, and I remember their targets as well. They blew away the targets very,
Yes.
very fast.
Yes, and that's true for Disney. What's unfortunate for Disney is it has a lot of legacy businesses. It owns ABC in the broadcast realm, and so many parts of its business are being disrupted as well. And what is also true is those businesses, those legacy businesses, are highly profitable. They're very mature. Whereas new businesses, when you have to invest aggressively to capitalize on new ways of doing things, is not as profitable in the early days. But it's absolutely necessary to do unless a company like Disney wants to be completely disintermediated.
But Cathie, do you think that the FANGs are going to be disrupted going forward? I mean, previously we thought that FANGs were the disruptors, and now we just see everything is going so fast.
Yes. Well, and I think that's a hallmark of what we're going to see during the next 5 to 10 years. Many of the innovation platforms around which we have centered our research, so multi-omics sequencing, that's what we used to call the genomic revolution, robotics, energy storage, artificial intelligence, blockchain technology, many of them are entering into their S-curve phases now. They are not only ready for prime time, they are moving into prime time. Now, maybe blockchain technology has had a bit of a setback because of the crisis and the fraud at what we believe is fraud at FTX. But even there, if you look at what happened during that crisis, the Bitcoin blockchain and Ethereum, neither of them skipped a beat. No transaction was interrupted. All of the margin calls that were automated by smart contracts, they were fulfilled. And in fact, that market, the transparent, decentralized market, did so much better than the centralized, opaque markets represented by the failures of FTX and Celsius, 3AC, and so forth.
I just need to ask you as well. Have you ever been to Sweden?
Oh, yes. Yes, I love
Yeah.
Sweden. Absolutely. Yes, yes, yes.
All right, just wonderful. Can you tell us more about your investing philosophy?
Yes. So our philosophy is really our focus. The most important thing is we focus on nothing but disruptive innovation. And the reason for that is the seeds that were planted in the 20 years that led to the tech and telecom bubble. The seeds that were planted then needed 25 to 30 years to germinate and are now beginning to flourish. The technologies back in the late 90s were not ready. And even if they were close to ready, the costs were prohibitive. So to give you a few examples there, cloud computing did not really start until 2006. And yet the tech and telecom bubble was imagining something like cloud computing. The technology wasn't ready. It was imagining artificial intelligence really coming of age. But deep learning, the big breakthrough, didn't occur until 2012. It was imagining personalized medicine. Oh, we're going to, because we can now sequence a human genome, we'll be able to personalize medicines once we understand each person's unique disease. Well, guess what? It took $2.7 billion to sequence the first person's genome, and that wasn't until 2003. So 2.7 billion, now we're down to $200. Think about that. Yeah. Think about that. In 18, 19 years, 2.7 billion to $200. We are ready for prime time for not only personalizing medicine more, but also, and many people didn't even think about this back then, curing disease thanks to new technologies like gene editing.
Well, what did they say about the world market for computers? Was it 12?
That's right. That's right.
But if you go, yeah, sure.
No. I think there have been moments in history where economists and strategists have said, well, we think everything that could be invented has been invented, and here we are in the most prolific period for innovation in the history of mankind. So 5 innovation platforms evolving at the same time has never happened. You have to go back to the early 1900s, telephone, electricity, and automobile, to see 3 platforms evolving at the same time. And that transformed the world. These 5 platforms are going to transform the world even more dramatically and much more quickly.
Yeah, we're going to come back to that because I found that wonderful slide at your homepage as well. But what I'm interested here before that is, if I look at Nasdaq and I look at the not all-time high level, but the highest level in the last 2 years compared to the lowest level, I can see a max drawdown from top to bottom at 66% on Nasdaq. In Sweden, it was 50, but 66%. Maybe you haven't seen the decline on the Swedish market on the index level. It's quite many banks, and banks are having a good time when interest rate rises, or have had at least for some time now here in Sweden. But if I look at the average stock declining 66% on Nasdaq, the only word I got in my head is crash. And if I go back to the IT boom and then the IT bust, how would you say that period compares to what we've seen in the last 2 years, or maybe since November 2021, when Jerome Powell said that the inflation is not transitory, we need to address this?
Yes, if you look at the drawdown for innovation strategies from peak to trough, it's actually steeper than the 74% during the tech and telecom bust. And what I just mentioned to you is, back then, the technologies weren't ready. And even if they were close, the costs were way too high, prohibitive. And a lot of companies went public on the Nasdaq that should never have gone public. They should have never been funded. Too much capital chasing too few opportunities too soon. And a lot of them went bankrupt. What I also just mentioned is, these technologies now are ready for prime time, and yet the drawdown was worse this time than back then. And the other interesting dynamic is, back then, investors were falling all over themselves to try and get higher and higher weightings in technology, 40% plus, because They wanted to beat the benchmark and they wanted to beat their competitors. And today, what they're doing is running for the hills. They're running for their benchmarks. And these stocks, the ones that are true disruptors, are not in their benchmarks. And as I just mentioned with the FANGs, these stocks are going to be the disruptors. So it's from a behavioral psychology point of view, I think the history books are going to have fun with this. Investors, couldn't get enough of technology in the late 90s, and that ended badly. And now they're running away as fast as they can from innovation, given the momentum in the markets. And we think that's going to end badly, that they're going to end up on the wrong side of change.
You mentioned running to the hills, and I know that this is something you've said in an interview with Barron's. And you said the investors are running for the hills away from our strategy. They're running to their benchmarks. Guess where there is more risk? It isn't their benchmarks, because the traditional world order is going to be disrupted and disintermediated here. We've seen a big wave of index investing in the last, say, decade or maybe more. I think I know the answer to this question, Cathie. But what is your view on index investing?
Yes, I think, especially given how much innovation is taking place today and how ready for prime time it is, we believe that index-based investing is actually the pendulum has swung so far that it probably will be considered the most massive misallocation of capital in the history of mankind. Now, that might sound dramatic because there is room for tried and true to some extent. But I think the pendulum shift has gone so far, and the traditional world order is so ripe for disruption, given the advancement of these innovation platforms, that the benchmarks are going to deliver subpar returns relative to innovation. And just to give you some numbers there, if according to our estimates, and this is work we did this past year, we're in the process of revising it now. But today, truly disruptive innovation in the global equity markets is valued at about $7 trillion. So it's less than 10% of the total global equity market. And that includes China. If we're right, that 7 trillion is going to scale to more than 200 trillion in the next 8 to 10 years. And that, we believe, that is somewhere between, we think the range will be a 40 to 60% annualized rate of gain when it comes to disruptive innovation. If that is right, then we think the traditional benchmarks, which do not own enough innovation, certainly not the most disruptive innovation out there, their returns are going to be pretty disappointing. And we truly believe that innovation will account for the bulk of equity market gains during the next 8 to 10 years. So that's why we say the risk is in the benchmarks. They're going to be disrupted, and they're going to have to evolve quickly if they want to catch up with the new world, given the speed at which these technologies are advancing.
But and this number, as you say, that the disruptive innovation technologies are ready for prime time. I found a number that said that the total addressable market was around 14 trillion back in 2020, and you estimate it will be 210 trillion in 2030. It's 15 times over. What needs to happen for that to materialize, or will it will materialize?
So what's interesting about the number you just pulled out, that 14 trillion, that was the number in 2020 as we calculated it. We are recalculating it now. That number has gone down to 7 trillion. So the upside is closer to 30 times than 15 times because of the drawdown during the last 2 years. I think the first proof point for us is what's happening to the FANGs. I think many people were very comfortable with their FANG holdings because these holdings were the top holdings in the Nasdaq 100. So the large cap Nasdaq. So tried and true. No, disruption is happening very quickly. TikTok became so much bigger, so much faster than anyone could have imagined. It became addictive, right? And that's how quickly we think other innovation platforms are evolving here. And a lot of this is because of artificial intelligence, which artificial intelligence training costs, according to our calculations, are dropping by 70% per year. Our calculation last year was 60% per year. It has actually accelerated, and or at least our estimate has been revised to 70%, which conforms now to what we're seeing with GPT-3, soon to be GPT-4, and the big breakthroughs that we're seeing with Chat GPT, which is taking the world by storm.
I love your example. It became painfully obvious how fast it took for TikTok to counter the world. And one thing that many has spoken about when it comes to TikTok is political risk. How do you interpret political risk when it comes to disruptive technologies? I know that around 95% of your holdings are in the US and around 4.5 maybe in Europe. I'm very interested to hear what you have found in Europe. But how do you interpret political risk when you invest?
Yes. So if we look at political risk, we can look at TikTok, and the U.S. government is banning it for national security reasons. So government employees cannot use it within any of their professional devices. And the risk is that governments around the world start to ban it for political reasons. So that's more of a risk for TikTok, I think. By and large, what we're seeing when it comes to political risk and innovation, we're actually seeing the opposite. We're seeing countries competing. They want to be at the forefront of innovation. And even if you look at blockchain technology in the United States, no regulator, even though they might say some hostile things against blockchain technologies, they don't want to be blamed from preventing the next big idea, the next internet. And as you note, our absence from Asia is probably noteworthy. If you had looked at our portfolio in late 2021, I believe that's right, or 2020, you would have found nearly a quarter of the portfolio in Asia.
Wow.
And yes, and a lot of that in China. Now, what happened was China in November of 2020 prevented the Ant Financial IPO and then basically banished Jack Ma. That was the beginning of a new regime. Xi Jinping, basically his heavy hand on enterprises. And we were concerned about that, started pulling away as we concentrated our portfolio towards our highest conviction names during the drawdown in 21 and 22. And so that now we have none. Now, why did we have such a big position in the first place? Well, China wants to be number one in innovation, as they have stated. And they are very nimble, agile. But now the government is getting in the way. And we saw them not only basically banish a lot of the leaders of the mega cap, the super mega cap firms, but they nationalized online education. They subdued the gaming market, and they moved into common prosperity, which to us means any company with a high margin is suspect, and the few names we still have in our more specialized portfolios have low gross margins in the single digit or low double digit area, and they are doing, their mission involves something having to do with common prosperity, which means in some cases logistics companies moving into tier 3, tier 4 cities. So, the government has a heavy hand and has become, I would submit, anti-capitalistic in a sense, or anti-entrepreneur. They might be changing their spots now. We shall see. But certainly what's happened in the last 2 years has not inspired confidence. And the other reason we moved out of a lot of Asia and emerging markets generally is the dollar was very, very strong and was presenting some real problems for these countries whose currencies were depreciating, and which forced a loss of purchasing power and a loss of wealth into those ecosystems. So that might be changing as well. So stay tuned. And in Europe, CRISPR Therapeutics is a Swiss domiciled company. It is one of the most important companies in CRISPR Cas9 gene editing. In fact, it is the first company with, I think it's more than 75 people in human trials, in which we're seeing actual cures of diseases. So sickle cell disease and beta thalassemia are the two it has been focused on. And we're quite intrigued that it is also investing a lot when it comes to R&D in curing diabetes. Talk about a huge unmet need. And in the US, one of the reasons that our healthcare bills are so high, the side effect profile of diabetes.
You have a wonderful example here as well when it comes to CRISPR. I looked at one of your YouTube clips, one of the latest ones. I think it was a 12-year-old daughter in a girl in England. And as a parent, I just it broke my heart, but it was very, very interesting as well to see the disruptive technology and what it can do for humanity. Can you please tell us about this example?
Sure. Yes, and what the reason I featured it and started tweeting about it is investor psychology was so negative that I saw no reports in the United States. I actually was in Asia and I saw the reports on the BBC, called back to the US, talked to our analysts, and nobody had said anything about it. And so there's a research hospital in the UK was treating this 12-year-old girl, and she had failed dozens of therapies. In fact, her mother had a beaded necklace with one bead for every therapy she failed, just waiting for the successful therapy when she would complete the necklace. And her daughter was on her deathbed. And so the hospital said, if you're willing to try this new therapy, it's first time in human trials. It is based on something called base editing, which is a derivative gene editing technology. We will try it. She did, and 6 months later, she was cancer-free. And now they had been fighting this cancer since she was a little girl, and there was nothing left to do. So it's bringing huge hope, as you say, to humanity. And I do think that we will turn cancer from a killer into first a chronic disease like HIV, and thanks to gene editing, which basically we believe, along with artificial intelligence, will be able not only to spot cancer, including pancreatic cancer, in stage 1 when we can do something about it, but we're learning, thanks to AI, how the genome sets up for that uncontrolled replication of cells. And maybe we'll be able to circumvent and prevent cancer in the first place. So it's really provocative what's going on, thanks to the convergence. And remember, I used that word in the beginning, the convergence between and among multi-omic sequencing technologies, artificial intelligence, and gene editing. All kinds of gene editing flavors are now being invented thanks to the miracles we're now seeing.
That's wonderful, just wonderful.
Yeah.
You spoke about TikTok recently, and you spoke a little bit about the chatbot ChatGPT as well. I know Microsoft invested $1 billion back in
Mhm.
2019, and now a couple of days ago they said they wanted to buy 49% of the company for approximately $10 billion. It was lower than the funding round valuation, but I guess it's nice to have Microsoft on
Yeah.
on the deck. ChatGPT, this has maybe shown the benefits with AI and taken the world with storm. What is your
Mm.
view on ChatGPT?
Yes, we've been debating and discussing this at our brainstorm for the last several weeks. And the first debate was around education. Oh, what's going to happen here to education if I can prompt ChatGPT and say, write me an essay of the history of space exploration? And in 1 minute, less than a minute, I get the history of space exploration. However,
Mm,
here's the wrinkle.
mm,
Uh, that essay will look beautiful, but it will be full of errors. Why? It, ChatGPT is trained on everything on the internet since the beginning of history on the internet. And what does that mean? Yes, lots of facts and figures, but a lot of misinformation, a lot of creative content like science fiction, and a lot of science fiction involves space. So this essay is full of errors informed by science fiction, and its citations don't even exist. So what this will do is change education. If a student decides to let ChatGPT write that essay, then that student is actually going to have to do more research, fact checking,
mm.
because the teacher will, who's an expert, will be able to say a big F on your. It looks nice, but you get an F because there are so many errors. So it's going to change education and make it a wait a minute, does this make sense? No, it doesn't. Let me do a little more research on that. So that's one thing. The other thing that we also have learned is that the internet is full of bias, human bias. And we know this because while Chat GPT will not answer certain questions like, okay, based on race and gender, who makes the best CEOs out there? Well, it won't answer that question because of the bias it attributes to the question. However, if you ask the question differently, what characteristics make for the best CEOs out there? The answer will come back: white males, because most CEOs are white males. But this is where human beings are very important in the process. We understand bias. We want to get rid of that bias. We should be able to train ChatGPT and others to fight bias, to negate any bias that it detects. So this will be an iterative process. It's very important, but I think understanding the weaknesses of associated with artificial intelligence are as important as understanding the strengths. And I think one of the biggest strengths is we're going to democratize education in the world, but we'll have to do this smartly. So we're very excited about this new world. And in fact, we look at artificial intelligence as applied to knowledge workers as the equivalent of what happened in the early 1900s when Ford created the first assembly line that was used in manufacturing. That was an industrial revolution. This is going to be a knowledge revolution.
Your view on risk differs from many investors and traditional asset managers out there. This has led to some criticism against you. Cathie, what is the risk in your book?
So a lot of people define risk with the word volatility. Volatility to us is more about uncertainty than actual risk. So volatility in our strategy is a function of the fact that most of our stocks, 95% of our stocks, are not in broad-based benchmarks. And therefore, because they're not in benchmarks, many people assume they are risky. And when we move into a risk-off period, a lot of portfolio managers and analysts sell our stocks just because they're not in an index and buy more of their index stocks to try and get closer to their benchmarks. We don't do that. We do the opposite. We believe the higher risk is in the benchmarks, as I described earlier, and how much the 5 innovation platforms around which we have centered our research and investing are going to disrupt the traditional world order. We believe from an actual outlook, futures-oriented point of view, that the lower risk is in our portfolios. So that idea of volatility and benchmark sensitivity influences how our strategies behave. But I do believe as we get more examples like the FANGs being disrupted when nobody thought they would be disrupted, while we still have $170 billion of advertising to flow from linear TV into the digital realm, we'll get more examples about that. We'll get a lot of healthcare examples of disruption. Companies that are not keeping up with these new technologies are going to have a real problem. We'll get a lot of examples in the transportation space as autonomous mobility takes off and the stranded assets associated with the auto industry, the rail industry, the airline industry are going to be recognized. So our view of risk is, and our attention to it is focused on both our top-down and bottom-up modeling, and then a 6-point metric system or a 6-metric system where we score from 0 to 10 attributes that we believe are critically important to innovation. And a lot of those have to do with the kind of management, the visionary management, willing to stand up to short-term oriented investors who want their profits now and their dividends now and don't want investing. Those companies, the ones that are investing, are going to win. It's around moats and barriers to entry. It's around execution. Are these companies spending enough R&D, and are they spending it in the right areas? It's around valuation. Many people don't think we look at valuation. We absolutely do. But what our approach to valuation is in the context of our 5-year investment time horizon. We assume that our valuations within 5 years are going to be roughly in line with the market, maybe a slight premium, as opposed to where they are now as our companies are investing aggressively. So that's an extreme compression of valuations, and our projections have to take that into account, and that headwind has to be more than made up with significant revenue growth, exponential revenue growth, and gross margin expansion. Another consideration here is profitability generally. Many investors and pundits look at our portfolios and say, oh, not huge profits here. And we're saying right back to them, you know what? Our companies, we encourage them to invest because these opportunities are massive. And in fact, because of artificial intelligence, many of these opportunities are winner take most. The companies with the best domain expertise, the best AI expertise, and the biggest pools of data, high quality data, those companies are going to win the lion's share of many of these markets, certainly in the autonomous mobility space, in the molecular diagnostic testing space, in the space race. So I think that our approach to risk is manifold. And then, of course, we have many eyes on these portfolios from a risk control point of view, exposures to sectors, concentration. We limit our exposures, or at least we can buy up to 10% of the portfolio in any one stock. But beyond that, there are risk controls. So we have a lot of eyes within the organization and outside the organization, our distributors, looking at these portfolios from a risk point of view. And we have to answer to them. And of course we do.
I guess that Amazon is a very good example, looking in the rearview mirror, when quite many said that they weren't earning any money, bottom line.
Yes.
But I mean, it was massive investments in R&D, and look where they are today. And I guess this feels like Wayne Gretzky, go to where the puck is going, not where it is right now. And another one is how the heck do you get a massive alpha without uncertainty and running with a crowd?
Yes. And even Amazon. So yes, it invested aggressively in the late 90s and early 2000s. And look what happened to it. It's a multi-trillion dollar. I remember in 2002, it was only a $5 billion. $5 billion. And that's where I think we are now in terms of a lot of innovation stocks. You know, they've been beaten up to these incredibly low levels, but the opportunities are so vast. And I'll just add one more point about Amazon. Another FANG. What is disrupting Amazon now? Two things. One, social commerce. Shopify, which is in our portfolios, is actually causing Amazon some trouble because Amazon is not a social network. You can go onto Facebook and Instagram, YouTube, and you can buy goods in app thanks to Shopify. This is competition for Amazon. It doesn't have a social network, so it can't do it. The other competition is Google and Microsoft. Google is willing to lose a lot of money every quarter to get a stronger foothold in web services, the cloud. So a real competitor to AWS.
Can you please elaborate just a bit on Shopify as well? Because I know this is a Canadian company. This has not been listed for that many years. I'm not sure, 2015 maybe. This is the biggest company on the Canadian stock market. It has gone massively fast, hasn't it?
Yes, it has. And, you know, experiences go viral on social networks. And so it makes a lot of sense. For example, my son bought a sweatshirt with a hot sauce logo on it. And I said, where the heck did you get that? And he said, Instagram. I said, oh, that's how a lot of people are shopping. It's impulse. I like that. And if social networks are viral, then shopping is going viral. And that is why Shopify has been able to scale so beautifully. And it is now getting into the fulfillment side of the business. Again, much more agile. And curiously, if you look at what Amazon has announced recently, it is starting to shut down or downsize warehouses. Well, guess who's coming in to take advantage of that? Shopify and its partners. So, you know, the world goes round and around, and disruption accelerates the pace of change.
You have exposure to trends like the next generation internet, genomics, as you've said, robotics, space exploration, and crypto. Which is the most interesting trend? I mean, maybe it's like saying, which child do you love the most? You cannot say, but is it possible to say which trend you think is the most interesting one going forward?
I think the one that is most underappreciated, mostly because of traditional healthcare investors. They're not comfortable with technology, and they're not comfortable with the speed at which the multi-omics revolution is evolving here. And they also, this is the platform that is in its infancy compared to some of our other platforms. And so a lot of the companies are investing aggressively, and they don't have a lot of cash flow. So they have been hammered by this market, and they're starting to recover. It's interesting. If you look at when our portfolios tend to do well in a bear market, it's towards the end of a bear market when the new leadership is being appreciated by the market. And we're beginning to see some evidence that this is the case in the multiomics revolution. The JP Morgan conference in early January is always a good time for announcements, and most of them have been good and breakthrough announcements, not bad.
Are there any technology trends that you think will become, I know I use the word maybe wrongly now, but fallen angels? Trends that you think will become something big?
Well, I can give you an example of something we didn't think would become big, and only now are we beginning to seriously consider investing. You know, solar has been around for a long time as an idea, a dream. It's a big idea. And yet, as we were doing our top-down analysis in particular, we began to understand that if solar did not have subsidies, it would not be viable. We're just getting to the point where we won't need subsidies as much. And in fact, if we add Bitcoin mining to utility ecosystems that are trying to accelerate their movement into solar and wind, that these utility ecosystems are going to be able to earn money by mining Bitcoin with the excess power from sun and wind after the storage units are filled. So this is going to accelerate the shift, we think now, towards solar and wind and renewables. But as you can tell, for a very long time, we stayed away from it. Another example that is coming back into focus is nuclear. Nuclear, this is a good example of politics, geopolitics getting in the way. Fukushima in 2011 caused Germany to shut down nuclear, Japan to shut down nuclear. Now even environmentalists are saying, hey, nuclear might be a good idea after all. It's the safest energy source out there, except for perhaps solar. And in terms of pollution, it's one of the least polluting. So we're going back to the future in terms of some ideas that were completely dismissed for either geopolitical reasons or economic reasons in the day.
Mm. I think this is very interesting, and I'm very keen to hear your view on the green tech revolution, and if you consider that as well as a disruptive technology trend that you're very interested in, because I know that the energy sector was the only sector that was in positive territory in the S&P 500 last year, up 59%. I think it started the year with a weighting of around 4.5%. Somebody on CNBC said it's like filling a glass with a fire hose. So everybody capital, everybody wanted in. You are quite bearish on the energy sector, especially on a secular basis. But Cathie, disruption in the energy sector, the green revolution, do you find interesting trends, disruptive technologies emerging here?
Absolutely. I was very amused to see last year the energy sector indices reaching for all-time highs as the oil price itself dropped from $130 to nearly $70.
Yes.
Now, what that's saying is that there's a bet that those energy prices are going back up once China's back, once the U.S. fills up its strategic petroleum reserve, once OPEC cuts back on production in response to the price decline. We think that that's a mistaken assumption. Sure, you're going to have rebounds here and there, but if we look at what happened last year, Russia didn't have many places to sell its oil. And so it sold to China and India for 30%, 40% discounts. I think China, even during its weekdays, months, has been filling its inventories for the past year. Why not with such cheap oil and taking advantage of a window in time when Russia's invading Ukraine? Not that we agree with that, but they did do that. And so I don't think that China coming back is going to be that much of a boost for oil prices. And one of the reasons for this is 24% of cars sold in China now, or last year, were electric, pure electric, not hybrid, pure electric, compared to roughly 5% in the US. But there's another thing happening that I think is more important, and that is you will see Uber, Lyft, and other ride-hail companies now buying electric vehicles. Hertz is buying Tesla vehicles aggressively because it has discovered that maintenance costs for Tesla vehicles and other electric vehicles are 50 to 60% below that for gas-powered vehicles. And that's a very relevant consideration for a rental car company. And so what is happening is electric vehicle miles traveled are increasing much faster than I think the market shares associated with electric vehicle sales, which suggest, or the market share of the installed base. So we believe that peak demand may have occurred in 2019. We have not gotten back there yet. We may get there this year, but if we do, it's in the context of a topping process. One of the other things we believe will happen this year is the US production will hit an all-time high, above 12.7 million barrels per day. It'll be the largest producer in the world once again. And that will cause a problem from a supply-demand point of view. So we think oil expectations are going to be disappointed, particularly those that suggest it's going back above 100 and could go to $130, $140. In terms of renewables, yes, the time is now, as I mentioned, the economics are coming into focus as being favorable. And as I mentioned, these other ways of subsidizing renewables with Bitcoin mining. To give you an example there, Exxon is using Bitcoin mining machines in its natural gas fields in order to take the energy, instead of flaring the gas or venting it, they are putting it into Bitcoin mining it. They're using it. It's not letting these emissions go in to the stratosphere. And especially with methane, methane is so much more toxic than carbon dioxide, especially in the first year. This is a huge, huge effort. And they're doing it in 6 different countries, I think, or at least 6 different venues. So I think this is going to become common knowledge that you combine these technologies, once again, convergence between and among technologies, and you get a very big idea.
Amazing. These days, we hear a lot of buzz around disruption, and of course, we're talking about disruption in this podcast and disruptive technologies. But this is not a new trend. Disruption has always been around, and I have this slide deck from your homepage, and I can see that you think the global economy is undergoing the largest technological transformation in history, which you said in the beginning of the podcast. From the steam engine in like, did you say
late
18th century?
1700s.
You see,
yes.
Steam engine, railways, internal combustion engine, telephones, automobiles, electricity, computers, internet, and now we come to the end of this graph, and it says a very just in a couple of years, it's artificial intelligence, energy storage, robotics, genome sequencing, and blockchain technology. When I look at this graph, it seems that everything is going so much faster, even though I guess that the disruptive technologies has always been around.
Yes, if you look at that timeline, and it is on our site at ark-invest.com,
yes.
What you will see is the history of disruptive innovation. It has been one major breakthrough at a time. The exception in that history was the early 1900s, as I mentioned, telephone, electricity, automobile. And what we're trying to measure on that chart is the productivity uplift and wealth generation that will be caused by these new technologies. So you'll see we went into the roaring 20s as telephone, electricity, and automobile were adopted at a mass market rate. And that was called, as I mentioned, I think I mentioned the roaring 20s. We could be back in the roaring 20s again.
Exactly. Yes. You believe in the roaring 20s again. That was a question I have as well, because I'm so interested in your answer. And I love that you think that we will be in the roaring 20s, because we've had harsh couple of years with the pandemic and so forth. We want the roaring 20s back again.
Yes. Well, if you look at this time, very similar to 100 years ago. In the late 19 teens, we had a pandemic, the Spanish flu. We had a war, World War I. Now, both of those were much more serious than what we've experienced in the last few years. This is an echo. If you look at inflation back then, we were on the gold standard back then. And inflation, because of supply chain problems, went up to 24% in June of 1920. And within 1 year, it was at minus 15% in June of 1921. That's because we were on the gold standard and money supply went down. Well, guess what? Money supply in the United States is going down today, almost like we're on a gold standard. And we have innovation. Well, we had the pandemic, we had the war, we had the inflation, supply chain related inflation. Now we think this year we will see deflation, and we would not be surprised to see inflation drop below 2%, if not go negative in the second half of the year. So this idea, the roaring 20s, if you look at what happened after we got through that very difficult period, 1921, the equity market delivered returns of roughly 25% at a compound annual rate for the next 8 years, I think, before we made a whole other set of mistakes in the form of too tight money and tariffs through Smoot-Hawley.
So you don't think that you are camp inflation transitory, and think that we could even get inflation in the second half of this year? I mean, inflation has slowed. Deflation. Inflation has slowed every month since June, 9.1% in the US. We got a new number today, 6.5% spot headline inflation to expectations. But you said it can even go negative. And I noticed that Adobe said that online inflation in the US in December was negative, deflation 1.6%. But you think it can go broad headline deflation this year?
Yes. There are two reasons. If you look in the first half of this year and compare to CPI last year the numbers were very big. Energy being a big part of it, and shelter as well. Shelter has a very long lead time. Energy does not. The decline in energy prices is getting in already. The decline in rents, and we are beginning to see housing prices come down, and in some places rents coming down. That should get into the index the second half of the year. And so we believe that is why could see negative year-over-year CPI in the second half of 23. If this is what the market's been waiting for, and we think it is, and we think it's what the Fed's been waiting for, then 23 should be a good year.
And you think that today's monetary policy is very influenced by Keynesian economics and the Phillips curve? Can you just elaborate a bit on that as well?
Sure. And it's interesting because what I'm about to say was not the case in the last 40 years. The Phillips curve effectively says, in order to get prices down, the unemployment rate has to go up. You know, if employment is too strong, then the idea is you'll get wage inflation, and that will be embedded in the system as workers become more demanding. If you look at the history, that played out in the 70s. But if you look at the 80s through very recently, that has not been the case. We went through a 40-year period of inflation and interest rates falling secularly, some of the biggest declines were in periods of the strongest growth. Why? Because of productivity. And if we're right about what these new technologies are going to do for productivity here, it's going to be a massive force against inflation, highly deflationary, actually. These technologies, we haven't gone into this, but we center around our research around how fast are the costs and therefore prices of these technologies are going to fall. And we use something called Wright's Law, which is a relative of Moore's Law. And we can delineate, we can graph out how quickly they will. And so just to give you some examples, for every cumulative doubling in the number of whole human genomes sequenced, so that means going from 1 to 2, 2 to 4, and so forth. Costs decline, if you're looking at short read DNA sequencing technology, by 28%. If you're looking at, that's 40%. If you look at long read, it's 28%. If you look at battery technology, 28%. Industrial robots, roughly 50%. I think I mentioned earlier that artificial intelligence training costs are dropping at 70% per year. And so these are highly deflationary forces and are creating really a deflationary undercurrent in the economy that we think will become quite obvious within the next few years.
That's really, really interesting to see how disruptive technologies can be a inflationary force. Yeah. Which long-term implications, if any, will be the result of us leaving the Mariana Trench when it comes to interest rates? Fed started the last year at 0 to 0.25%, and we ended the year in the range 4.25 to 4.50. Do you think there will be any negative implications here on your universe?
Actually, to the extent the economies around the world continue to weaken in the face of these massive interest rate increases. We've never seen anything like this. An 18-fold increase in the Fed funds rate. This has never happened in the history of Fed policy. I think that's a 3,000% increase. The closest we got was 1,000 in 2016. And remember, the Fed had to pivot because the economy started to weaken considerably. And there was a great fear about China really going into a cyclical downturn. So I think history books will be written about the impact of this. But what you'll also notice here in the United States, two cyclical sectors have already been hit so hard. And we actually think we've been in a recession since the beginning of the year. If you look at pending home sales in the United States, they're down 40%. I saw KB Homes orders are down 80%. They came out in the last few days. If you look at auto sales, they're at recession levels, 13.1 million units in the United States, 20 million in China. Those are both recessionary levels. And so what would have to give now for the economy to show really negative growth? And the inverted yield curve, so long rates being lower than short rates by this amount, 75 basis points, has been historically associated with minus 2% real GDP growth on a year-over-year basis. How could we get that when so many of the cyclical sectors are down and out already? It would be consumption falling. Consumption typically doesn't fall, but our saving rate is at 2.4%. It's near a record low here in the United States. So the consumer doesn't have much of a buffer. If the economy turns down, our results are going to look spectacular, meaning our revenue growth rates compared to most other companies. And because of cost cutting, as the market has become pretty hostile, even the margin structure of our companies is probably going to surprise on the high side of expectations. So we tend to do well, especially towards the end of a bear market. And now that inflation is starting to come down, I do think the Fed, maybe it goes one more time, but I doubt we'll see much more after that. And we actually do believe by the end of this year, we'll see a pivot.
Oh, wonderful. Do you think that rising interest costs will weigh on R&D and therefore become a threat to potential disruptive technologies? Companies that put less money in R&D because capital is more expensive now than before.
Well, we're watching our companies very carefully. If we are seeing them cut muscle instead of nice to have, then our confidence goes down. Our scoring system will take them down. And they'll be part of the concentration towards our highest conviction name, towards those companies that continue to invest aggressively. I think in terms of interest rates, the worst impact has been seen on our companies because what should be in the market is what the Fed has been saying, and that is, maybe a few more interest rate hikes, but probably not that many more. If the market is at all a discounting mechanism, which it should be, looking into the future and discounting, it should be starting to discount lower interest rates now, not higher interest rates, which would be very favorable to our strategy because the present value of our future cash flows will be going up then.
Yes, you are investing in kind of long duration assets. Of course, it will get a swoosh if we get the lower rates, which we hope for. And you don't run with a crowd, Cathie. ARK Innovation ETF soared 148% back in 2020, then fell 24% in 2021, and fell another whopping 67% last year. So massively outperformance in 2020, and then falling back in 2021 and 2022. But you aren't beaten down. You are doubling down. So what I'm interested in is how do you and your colleagues find your conviction when everybody else is running away from those names?
Yes, the courage of our conviction comes from our research, no doubt about it. Our analysts are domain experts. We have broken out our analyst responsibilities by technology, not by sector. So they're technology specialists and they are sector generalists. Why? Because we do believe these technologies are going to scale into mass market opportunities. And if anything, during a period like we've just seen, costs are now coming down even faster for our companies, primarily because they know they don't have as much room for error, so they're being very careful with the cost side of their equation. And they will ride down these technology learning curves and continue to cut costs. So the leverage being built into the future profitability of our companies is enormous. And so that's our conviction. I think the other thing is we have a 5-year investment time horizon. The market, when it goes risk off, tends to have, if it has a 1-quarter investment time horizon, that's a lot. They're usually looking backwards. And we think that's the wrong place to look for innovation. Innovation is all about the future.
And the right place to look for innovation and disruptive technologies is to look at your portfolio holdings. Let's talk about your innovation fund. Which are your top holdings?
So the top holding, and it just moved into that position this week because it announced much higher than expected cash flow guidance for the fourth quarter to be reported and much more rapid growth. That company is Exact Sciences. Many of your listeners will not have heard of that company, but they will have heard of something called Cologuard. Cologuard is a test for colorectal cancer. And it's a fecal test that can be done at home. This company is now moving towards blood-based tests for colorectal cancer and for pan cancers. And its revenue growth rate for the fourth quarter, if you have to X out, divestiture and currencies. So we're always looking at organic growth, local currency, is in the high 20s. I guarantee you the economy is not growing anything like that. And I think many people are looking at this saying, what happened? And I think what we have here is a company that is innovating very rapidly in the molecular diagnostic testing space, using some of the most comprehensive data and its domain expertise to come up with pan-cancer panel tests, which will help with early detection, not just in colorectal or in breast, which they also are known for their Oncotype breast cancer tests, but across cancers. And the other thing, that the fact that they were able to streamline costs and declare that they'll be cash flow break even in the fourth quarter shocked people. Now we're looking carefully at what have they cut here, and we'll learn more when they report the quarter. So that's an important consideration. But that stock was up. I think it's been up 35% in the past few days, and it leaped into first position. Tesla, Roku, and Zoom are also among the top 5. Tesla has been hurt badly recently, but if anything, our confidence in Tesla's position is growing because we think it is launching into a cost-cutting campaign now that supply chain issues are over, and will cut prices fairly dramatically. And on March 1st, during Investor Day, we'll announce a new car, which we think will debut in the $25,000 to $30,000 range. And the cost will fall from there. And that's probably going to be a robo-taxi. So we're pretty excited about that. It's been hurt by news from China, news from the US, car sales weaker. And yet, if you look at its sales growth in the US, up 46% when total auto sales were down 8% last year. And I think up 49% for the whole company when global sales were flat to down. So we think it's going to continue to take massive share moving ahead, and that it is moving the technology so much faster than most other auto manufacturers out there. Roku, the shift from linear TV advertising to connected TV, we think Roku is going to be one of the biggest beneficiaries out there. It's a television operating system and one of the few choices people have out there. HBO sits on its platform. Disney sits on its platform. Most of the big names sit on its platform. And Zoom, we think, is going to be the beneficiary of the first rip and replace cycle in the enterprise communications space, which is the largest part of the tech stack. It's $1.5 trillion per year spent. And we believe that they and Microsoft will be responsible from taking what is now a hardware-centric on-prem communications ecosystem dominated by Cisco into the cloud. And we're pretty excited about how inefficiently priced that stock is. It's priced at probably 10 times EBITDA, which is about 30% less than the market's valuation.
I can say that the Exact Sciences has 211 owners at our platform. It's quite low. I guess that number will go up after this cost. When you talk about Zoom video communications, I think about Google Meet and Microsoft Teams as well. Some people say that Zoom might be a one-trick pony and that you get the exposure to this trend via Alphabet or Microsoft. But on the other hand, it seems like ARK, like you love the pure plays.
Yes. And what you will see if you look at the shares, and it's hard to get at these shares, but I think SimilarWeb does a pretty good job. And it tries to get at the service that is catering to not to intra-company, inside companies. Most of those, even we are on Teams because of the compliance, how robust the compliance is at Microsoft. But if you look at company to company, so inter-company communication, you'll find that Zoom has a much higher share than either Google or Microsoft. Its share is around 44%, and Microsoft is about 16%. So Microsoft is used for internal communications, but if you're trying to make a sale, which is one of the most important reasons for an outside call, most people would prefer to be on Zoom, and Zoom should at least be the second choice if companies need redundancies, which they absolutely do, in their communications ecosystems. Google has never been adept at enterprise sales, and we think that will be the case here. You hear about tech companies, startups using them, but you don't hear about enterprises committing to Google.
Tesla, I need to ask another question on Tesla because otherwise our customers will be angry with me because many of them love Tesla. It's the most owned American stock on our platform. It has 88,185 investors. How should we think about Tesla, and what is your answer to the main arguments from the critics saying it's lunatic? I mean, now it has come down quite a lot. How should we think about Tesla? Is it tomorrow's ecosystem, not just the cars or all the information it has gathered the last 10 years, and solar and battery technology? How should we think about the long term of Tesla?
So we are in print, and for Zoom, Roku, Exact, and Tesla, you can find our models on GitHub and on our website, ark-invest.com, and you can see how we built our models, and you can play with the models if you would like. So we're in print as saying that our 5-year price target for Tesla is roughly $1,500, a little more than that actually. But you can dissect that $1,500. Remember, the stock is about 115 right now, so that's more than it's almost a 15-fold increase. 2 ways to dissect it: just electric vehicles, just that forecast. We actually think we could be too conservative. Tesla just announced that it is going to put a plant in Indonesia and use the raw materials to vertically integrate there. So just on its electric vehicle forecast, or our assumptions there, we get $500 in 5 years for Tesla. In order to get to that 1,500, we have to assume that it will become an autonomous mobility ecosystem, a foundation model, effectively, in AI terms. And we do believe that's going to happen. In fact, the fact that it has opened up its full self-driving platform to anyone who has requested it and paid for it tells us that they're getting very close. And I can tell you, proof of concept is at Cruise Automation, which is owned by GM. Tasha Keeney, our analyst, and I took rides in autonomous cruise automation cars in San Francisco a couple of months ago. And it's happening. It's already happening. So this is not about if, it is happening. And we think Tesla will go national. It won't go city by city. So it will be a big burst of activity when it happens. And if you look at the margin structure of autonomous mobility, that's a SaaS-like margin structure. In the 80% gross margins, whereas the EV side of it is in the 25 to 30%. It could get up to 40% if we're right on what Tesla's doing here, innovation-wise. But that is what catapults us to the 1,500 within the next 5 years.
I know that Peter Lynch performed a CAGR of 29% during his 13 years at the helm of Fidelity Magellan, but the average fund investor actually lost money because the markets are volatile. You're trying to hop in and hop out. Your universe is even more volatile. What is your tip here, your advice for customers interested in this fund? How should they, what expectations should they have? And what I can see, that you still have net inflows in the US. You have loyal investors. They're not running away from your fund. They're running towards
Right.
your fund.
It's been very interesting and we've been very gratified. I think our social media strategy, giving away our research, we get a lot of gratitude for that. I think our investors feel they're on the journey with us. And the way we've described what we do to help people really understand the mindset they need is we are the closest you'll find to a venture capital company in the public equity markets. Now, what does that mean? It does not mean that our companies are going to fail and we're going to have some huge winners. No, not at all. There's a vetting process that our companies have gone through. It's called an IPO, initial public offering. And so we've got a lot of eyes on it. We've got the regulators, we've got the bankers, we've got the buy side, we've got the sell side analysts. And so the odds are very low that our companies will go bankrupt. But we do believe, given the shellacking that this strategy has had over the last 2 years, that it will deliver venture-like returns. And that depends on what study you're looking at. But in our world, given how badly these stocks have been hit, while our minimum hurdle rate of return is 15% at a compound annual rate over 5 years, because of the down rounds we've been
Doubles
through
the
in the
money.
last, much more than that, much more than that. So yes, yes, the 15% is double. Our expectation is much more than that during the next 5 years.
So during the next 5 years, if you get 15% CAGR, you're doubling your money. At least you expect much, much more than that. I know that we're way off our time. This is very interesting. So I just have some few short questions left. One is that I need to ask you, do you ever get the stomach pain when you see the volatility in your portfolio?
Well, what I'm thinking about when I see that volatility typically is opportunity and how do we concentrate our portfolios towards even more towards our highest conviction names. We've gone from 58 names to fewer than 30 now. And it depends on the strategy, of course. Some have their minimums. So that's one of the thoughts. But then my second thought is about our clients and hoping that they understand that they are keeping their eye on the long term and that they understand, based on what we're sharing with them, our research, that the opportunities that these corrections are creating are, I think, once in a lifetime. Because again, we've never seen this many platforms evolving at the same time. And unlike the late 90s, when the technologies were not ready or the costs were too high, technologies are ready now. The costs are low enough, and we are moving into prime time. So just helping our clients keep a focus on that long term and how big these opportunities are is an important role we play. And we just ask our clients to read our research and listen to our webinars and look at our tweets. And use any of our social media outreach to understand how high our conviction is in our strategies and how importantly these technologies are going to transform our lives.
So the medicine for stomach pain is just deep analysis and high conviction. And I know that media loves to compare your performance to Warren Buffett, which is more value oriented. Do you think it's a fool's game long term to hide out in value stocks? And Buffett and his team has actually invested, of course, in Apple in Q1 in 2016, which is the greatest holding now, and he's invested in Amazon as well. Do you think it's do you think it's a fool's game to hide out in value stocks?
The history of value strategies has been pretty good. Very good, with the exception of maybe the last 10 years. Now, it's another way to look at the market, another way to invest. It probably complements our strategy very well. But I will also tell you, we consider ourselves a deep value manager if you give us 5 years. And in fact, one of our institutional clients has told us that they invested with us for two reasons. We're the closest to a venture capital fund in the public equity markets, and we behave like value funds. We actually lean into the declines in our stocks and concentrate more into our highest conviction names, which is what value investors do. And you asked me what else goes through my mind when I'm watching a stock get really hit or the portfolio. If it's a stock, I remember my last conversation with the CEO, and I am always taking confidence or lack thereof from the way a manager expresses his or her own confidence about the outlook when we're asking some tough questions. I think that's really, I probably, those flashbacks happen regularly when we see a very tough period in the market. So combine that with our own research, and we've got a concentration strategy.
When it comes to, I have two more questions, but when it comes to Tesla, back here in Sweden, there has been a lot of buzz around him entering Twitter and more of his focus going to Twitter and maybe less to Tesla. And I guess that have affected the stock as well. And investors start thinking about how will we interpret this long term and how will this affect Tesla? What is your view there?
Well, Elon has been CEO of many companies for a long time now. Boring, SpaceX, Neuralink, yes, Tesla. If you look at what's happening to SpaceX, it's almost on automatic pilot now. They had 61 launches last year, and the reusable rocket strategy is playing out. I don't think he's much involved on the day-to-day there. He's more involved strategically. Same with Boring, good success there, especially at the CES, Consumer Electronics Shows. They put out some statistics. Seems like that's on automatic pilot, and he might be brought in occasionally to negotiate with the government. Neuralink, very early stage, a lot of scientists working there. And Tesla, I think his most important project to him is to save humanity from itself and get electric vehicles out there and autonomous mobility so that electric vehicle miles traveled increases faster than the installed base of electric vehicles. He's very focused on that. And then when you talk about Twitter, to him, that's an AI project as well. He's stated he does not want to be CEO. He's going to step down. He's looking for the right, he's first of all cleaning house, looking for the right person, and wants to be involved mostly on the AI side. Open up those algorithms, make them more transparent, take the bias out of Twitter, and take the censorship out of Twitter, and turn it back into the global public town square that it was meant to be. Even Jack Dorsey says they lost the plot. So I think that now that the house cleaning is pretty much done, I think they just went through another layer of layoffs. I think he'll bring someone in, and we'll have to worry less about that. A
true visionary man. Just look at what he have done with Starlink in Ukraine as well, and just level the playing field.
Yes.
Many colleagues working within the tech space got stock-based compensations in the last couple of years. You should buy stocks when the blood is on the street, but I guess that this might give a headwind for companies saying that you will get this salary, but you will get stock-based compensation. I would love stock-based compensation after a market crash. I would love it, but maybe not all. Do you think this will be a headwind for companies attracting the absolutely best talents out there?
Well, actually, what's happening is public companies are beginning to be the beneficiary of seeing more talent. And the reason is private companies. A lot of private companies were hiring people who agreed to go thinking there would be an IPO and they'd, make a killing. within 6 months. Well, that window has closed, and we are beginning to hear from our companies that there's a talent exodus from private and back towards public, which is much more stable. So they can come in at stock option packages today that are very attractive. And of course, for those who are there, it wouldn't be fair. I know we'll see some repricing of options, and we understand as public shareholders, in order to keep some talent, we need to accept some dilution. And talent is treasure. We should want a company to attract the best talent in order to execute upon the strategies, which are pretty awesome in their magnitude, and we'll just need the best talent to take us there.
Mm. Last question. How can our customers that are interested in this and will get an exposure, will invest in this fund as well, how can they stay on top to learn more and ensure that they are updated with everything that you put out there?
Well, I know that Avanza is going to do a fantastic job, but we will supplement it with our website where you'll see all of our research. And with podcasts, we have an FYI podcast, for your innovation podcast, every week. We also do regular webinars and special webinars. And of course, if you're on Twitter, you can follow all of our analysts. All of our analysts are on Twitter. They have their own handles. The word ARK is in the handle, but their name is there too. Their names are there too. And so if you have a special interest on one specific technology, follow that analyst. And you can find their names and their handles on our website ark-invest.com as well.
Wonderful. So for your information goes for your innovation. I love it. Cathie, you have disrupted my mind. I have loved this podcast. It has been great. And I'm really looking forward to our partnership to bring your disruptive technologies to the Swedish market. Thank you very much for joining this podcast.
My pleasure, Nicholas. I loved it. You asked some very provocative questions and gave me time to explain what's going on here. So thank you for that. And all of us at ARK, we're so excited with our partnership with Avanza, and I'm looking forward to getting back to Sweden again. So we can meet in person and you can meet your clients.
We'll meet back in person and we'll eat Swedish meatballs as well. I'm looking forward to it.
All right.
Thank you very much.
Okay. All right. Take care. Thank you so much. Cheers. Bye-bye now.